Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today, we're going to talk about the utility sector. And joining me today is Brian Durno, our portfolio manager responsible for the sector. Welcome, Brian.
Thanks, Mike.
Great to have you on. So just a reminder, utilities encompasses electrical generation, telecoms, and pipelines. And Brian, I thought, and we've been talking about this in a few sectors, interest rates. And look, we know interest rates impact, generally speaking, the market, but this sector in particular seems to be interest rate sensitive. Can you talk about why that is?
Yes, well, you're quite right. This grouping of sectors is considered the most interest sensitive of the group. And actually, we were just looking at some of this data recently, and I'll give you two or three different reasons why it would be considered interest sensitive. If you look at the yield that's earned from this space generally, so the dividend income, and you run that number using Canadian data over the last 12 years, you'll find that about 75% of the total return from this space comes from that dividend yield. So it's investors are attracted to the dividend yields a lot more than they are for capital appreciation. Right. So for the first time in let's say a number of years, the competition from bonds is negatively pressuring the prices from this sector. And that is one point to note there. The other thing I might mention is just the stable business models that are underneath the hood in the utilities sector. Because they're relatively stable and predictable cash flows, they tend to have a little bit more debt level than, say, the average company. So that obviously makes rising interest rates impact their cash flows negatively a little bit more than, say, the average company. So that's another more fundamental reason why you might find interest sensitivity from this group. And then maybe the last point I'd make is just more generally about all the sectors. Interest rates do kind of act like gravity for valuation models. And right. When the risk-free rate rises, you do have this sort of pull down generally in valuation levels. Right. So that's kind of put all those three things together. You have a perfect storm of sensitivity.
So basically, investors have alternatives where they can put their money to work. That has an impact. And then to your point, these players tend to have a pretty, a higher debt load. And so we know that the higher interest rates will impact their bottom line as well because they have to cover the interest expense. So makes sense.
Yeah, I might even say like even BCE is an example just this quarter, a 22% increase in their interest expense. Like that was sort of what happens. But I should also mention that a lot of these companies, at least in our group, the ones that we look at and that we're attracted to, use the super low interest rates of COVID to lock in and extend their maturities for much longer periods of time. Right. So even though interest rates have risen, which is clearly true, a lot of companies have been able to sort of delay the effect of rising interest rates on their balance sheet.
Right. And that's a good point in terms of our quality selection process. You're looking for management teams that, again, I repeat this, everyone knew interest rates were going to go back up. They're not going to stay at near zero forever. Again, not many predicted it was going to go up as quickly as it did, but those, call it in my vernacular, the better quality management teams would have said, yeah, let's lock in at these lower rates. And so good to see that some did that. So why don't we dive into pipelines? How did the businesses fare, and then how did the markets react?
Yeah, this is an interesting sector. If we look at, so we did a little comparison of the last time, because if you believe the case that rising interest rates have an effect on valuations, we took a look at the last time interest rates were as high as they are today. And you have to go back to roughly that 2004, 2007 timeframe to find interest rates at these levels. And we thought, well, that wouldn't it be interesting to look at what multiples the pipeline group, let's use TC Energy as an example. That's the old TransCanada pipelines back then. Right. What did they trade at during the last time that interest rates were this high? And if you run those numbers, the range between 2004 and 2007, that stock traded for around 14 to 20 times earnings with an average of about 17 times. Right. So even though interest rates were still, pretty high back then, the valuation levels that the market afforded these companies were still, relatively high. And that compares to today, TC Energy trading around 11 or 12 times.
Wow. Okay.
So they've been disproportionately, let's say, punished by the market in this environment. And that actually makes them kind of interesting from a valuation perspective to look at. And of course, the dividend yields from that group are very attractive.
Okay. All right. Good. Let's talk electrical generation. What are we seeing there?
Yes, well, this sector is almost your poster child for stability with respect to dividends and revenue and all those kinds of things. And one of the things that is very useful to remember about this sector is a lot of the of the returns that these companies earn are regulated by the government. So there's just been a couple of recent cases I can give you an example of. But so Fortis obviously have utilities operations all over North America here, but we'll just pick a couple of jurisdictions where they've been able to renegotiate higher rates of return, regulated rates of return. So that's like your return on equity, which is a very important factor for companies. That number is regulated by the government, or the regulators, not the government, the regulators in this case. And the most recent increases in ROE from actual decisions that have happened, one just last week, increased the allowed ROE, the return on equity from this company, from 8.5% to 9%.
Right.
And so the average increase in ROE has gone up by roughly 50 to 90 basis points from that space. So you think of what other companies have to do to earn an extra 50 basis points on their ROE.
Right.
They got to lower their prices. They got to cut costs. They got to do all kinds of things to squeeze out an extra ROE. Well, Fortis, all they had to do was show up and argue that interest rates had risen, and they achieved a higher ROE because the regulator does not want these companies to not invest in continuing electrical generation, because it is kind of a critical.
When you brought this up, honestly, it never kind of clued into me that, wow, it's on the return on equity in terms of the regulator. To your point, again, as a consumer, you may not be thrilled. They're basically in their various geographies or regions, they're basically a monopoly. And so hence why they're regulated. But as an investor, okay, pretty predictable as, when these things happen, it's like, okay, well, that's good. And to your point, it's a good incentive for them to keep investing in their infrastructure.
That's right. It's one of the things, like Fortis, as the example that we talked about, have actually increased their dividend every year for the last 49 years.
Right.
And so you think, well, how can they do that? Well, obviously, this is it's almost a locked in value creating enterprise, because the regulator is not going to give them an ROE that doesn't cover their cost of capital.
Right.
Because otherwise the business isn't creating value. So it might not be a huge amount of value. It's not like it's a 40% ROE or a 30% ROE, but it's an ROE that's higher than their cost of capital. And that is the very definition of value creation.
Exactly. Okay. Let's turn to telecoms. What are we seeing there?
Sure. Yeah. Another example where this interest sensitivity has sort of had a double effect, not only on the interest expense, but also on the valuation. But we figured we'd just use Bell Canada as an example here. The dividend yield from Bell right now is 7.2%, which is, historically relatively attractive. And we decided to kind of dig a little deeper into one of the things that's been constraining their cash flows. And if we looked out over a long period of time for a company like Bell, they generally spend, roughly say $4 billion in capital expenditures to support their business. And then you'll see this sort of bump up in the last handful of years where the $4 billion turned to around just over $6 billion. And so that spending obviously has an effect in the short term. They have to invest in their business. What did they buy with that extra $2 billion was spectrum for about $2 billion. Also this fiber to the home investment for 5G, and to actually make their business a little bit more competitive. So that's all part of what went into that extra $2 billion in spending. And so when you look under the hood at that, you say, well, that wasn't a maintenance of their business. That was, let's say, an enhancement of their competitive position in the marketplace. And just like any other business, if you invest $2 billion today, the gains from that business might take 5, 10, 15 years. It might be a long lasting project. And so if you think even your own experience of your internet and how important it is to you, and the ability for faster speeds to enhance the prices you might pay for faster download speeds, that's one of those things that we kind of looked at that CapEx, that capital spending by Bell, as, let's say, a value creating capital expenditure. Like, it's defending the moat of the business. So even though it constrained their cash flow in the short term, it wasn't something that we thought was, let's say, something you should punish them for in the market.
Exactly. And I can personally attest, as I speaking to you now, I'm a Bell fiber to the home. They just rolled it out. I'm in a downtown area, and it was impressive. They rolled it out, and yeah, I switched, and better service, and obviously better revenue for slightly increased revenue for Bell. But it's nice to support one of our core pick list companies.
Well, and that's right. This sector in general, it's useful to remember that these three groups that we just talked about are notoriously defensive.
Right.
And so when times get tough, these are the kind of companies that people tend to be attracted to in a downturn because of the stability. And It was only back in 2022 that this sector outperformed the index by almost 20%.
Right.
So even though this year we might be taking a little bit of headwinds from the space, and so maybe there's a little bit of mean reversion happening here in 2023 because of the interest sensitivity, but we still believe that these grouping of companies have defensive characteristics that are attractive inside of a portfolio.
Right. Makes total sense. Okay, Brian, thanks for this.
Well, thank you for having me.
Yeah. As always, folks, if you have any questions, reach out to your financial advisor at your accounting firm, or reach out to chat with your TriCert portfolio manager. And as always, don't hesitate to reach out to myself. Take care.